What impact will tariffs, taxes, and the stock market have on our summer housing market? We're going to answer that question and more in our summer market update and forecast. I'm Brett Jennings with Real Estate Experts. And as we start this conversation, it's really important to understand what fundamentally drives the real estate market. Well, I always like to say that real estate is a supply and demand driven market, which makes sense, basic economics, tempered by interest rates in the stock market. So the supply and the demand are the basic fundamentals, and then we have interest rates that are a little bit like the brakes in the stock market, which can be like the gas. So these four factors determine really what happens in our market. So let's take a deep dive and take a look at each one of these variables. First off, let's look at supply. Overall number of homes for sale has increased substantially. We're up 70% year over year with our increased number of listings, both in single family homes, but especially in condominiums. Now, it's not that 70% more sellers are coming to market this year. What happened was on April 4th, when our current administration announced this Liberation Day with tariffs, that really put a monkey wrench into our normal spring market. As we saw, the stock market declined, interest rates went up a bit, and buyers really put their searches on hold, yet we still had the normal seasonality of all these sellers putting their homes on the market in the spring. That's led us to a place where we have about 1.6 months of supply. Now, although supply is higher than it's been in years past, it has slowed things down, but it is still a seller's market in most places. I would say the one caveat to that might be condominiums and townhomes, because we are seeing inventory levels so high there that we're starting to see some prices decline. What is causing, although we have more sellers selling, that not everybody is selling? Well, one of the things that's happening for sellers out there is something called a lock-in effect. And that holds back many people from putting their homes on the market and also buying another home in the market. And the reason for that, what you see here, is that 70% of people who own a home have a very low interest rate. 70% of homeowners have an interest rate below 4%. What does that mean? That means if they were to go just move down the street and buy a similar sized home, their monthly payment, because they're going from a 3 or 4% mortgage to a 7% mortgage, just buying the same house would go up by about $9,800 a month. So that's keeping a lot of sellers on the sidelines, which has still kept our supply relatively low. Now, here's what we're seeing. Bottom line is that homes that are priced well and show well are still moving very quickly. This is a typical profile we see when a home comes on the market. They'll have their first open house weekend. Single family homes, we're still seeing a good amount of traffic. Condominiums and townhomes definitely are lighter. If the home is priced well, they'll typically see offers in the first 7 to 14 days. If the home is priced right at the market, it might take a little bit longer. And if it's overpriced, we're seeing those homes sit on the market for 30 days or more. Now, so what's happening with demand? Well, buyer activity is normalizing. This is a quick recap of what we've seen in the last 4 years. 2021 and 2022 during COVID, we had this real estate frenzy. Literally, we couldn't keep homes on the market for more than a week. There were far more buyers than there were sellers. And that really went through all the way from 2020 to 2022. In 2023, we really had a cooling market. The interest rates had gone from 3% to 7%, and things really slowed down. And last year in 2024 was really a market recalibration. Things were stabilizing and prices were recalibrating. This year, what we're finding is we do still have relatively low inventory. The buyer demand is there, but it's very selective. With interest rates being relatively high and supply being pretty good, buyers are being picky in the market. Here's what we're seeing of prices. This is looking at Santa Clara, San Mateo, San Francisco, and Alameda counties. What you're seeing in the dark bar graph there on the left is what price per square foot was in 2024, last year. What you're seeing on the right there, the lighter blue colored bar, is the price per square foot for 2025. So overall, we are seeing higher prices across the board in all of the Bay Area counties. Now, so that we talked about supply, we've talked about demand. What's happening with rates? Well, mortgage rates have come back up over 7%, and 7% is a critical number. For the last 30-year fixed mortgages, rates hit 7.07 in May. It was the highest interest rates we've seen since 2023. What that does is it really squeezes the affordability for buyers. The purchasing power goes down, and so this is actually a breakout of what it really means when interest rates go up and the effect that it has on buyers and their budgets. For example, a buyer who can get a loan at 5% with a $10,000 monthly budget can purchase up to 1.86 million. That same buyer, if rates are at 6%, they can only afford 1.67. At 7%, they can afford 1.5, and at 8%, they can only afford 1.36 million. So effectively, each 1% increase in mortgage rate reduces a buyer's purchasing power by about $100,000. And that's why interest rates are so critical at this stage of the game. 7% is a critical number. I say that because if rates push up much higher than 7, we start to see prices of homes and condominiums go down, and we're right at that critical number. Here's the interest rate outlook for 2025. Best case scenario is we will see rates come down. There is a forecast that the Fed may cut rates in the middle of June. If they do come down between 6.25 and 6.75, that could boost our summer market. The likely case is they will stay much like where they are, between 6.7 and 7.2. In that case, we'll probably see prices of homes stay relatively stable. And the worst case is if these tariffs unleash another wave of inflation and the Fed has to raise interest rates and we see mortgage rates go above 7.25 and start pushing to the 8% number, we will see prices decline. So last thing we're going to talk about is stocks. What impact does the stock market have on real estate? Well, the stock market really interrupted our spring market because the NASDAQ dropped almost 20% from the highs at the beginning of the year. And what we can tell you from experience is when buyers are out in the market and they work at Apple or Netflix or Google or Meta and their stocks are down 30%, well, you better bet that they are thinking twice about cashing in their stock when it's down 30% to put a down payment on a home. Now, the good news is, since the tariff conversations have stabilized a little bit, the stock market has come back and the NASDAQ's only down 6% from the peak, and we are seeing buyers enter the market. But effectively, what this table is telling us here is that when the stock markets decline, what we see is those buyers have less money in their down payment funds, and it causes hesitation. And then they start getting, when they're hesitating, they start getting very, very picky. And that's the market that we've been seeing this spring for buyers. Homes have to be priced right and in really great shape to move. Now, and this is just another echo of that, is that when the stock market drops, housing pauses. So we've seen about an 85% correlation between stock market and home prices in Silicon Valley. So what's our forecast? The scenario for the summer and fall of 2025, here's 3 scenarios and a weighted probability for each of them. Scenario 1 is we see a flat market. What that means is interest rates stay between 6.5% and 7%, that our stock market stabilizes but doesn't really increase. What we'll probably see there with home prices, that home prices will stay within just a few percentage points of where they are now. And the market may continue to slow just a little bit with days on market, instead of being 7 to 14 days, more like 15 to 20 days. The probability of a flat market for the summer is about 60%. The scenario 2 is that we face a correction and that interest rates go above 7.25%. We might see some layoffs in technology and our stock market goes down. If that happens, we could see prices, home prices, drop by 5 to 8% between now and the next 6 months. That would also cause days on market for homes on the market to be higher in the number of days. And the probability, however, for this scenario is about 25%. Now, best case scenario, we see demand surge, and that would happen if we saw interest rates come down below 6.5%, our stock market takes off, and hiring accelerates through the summer months. If that happens, we could see prices, home prices, go up between 5 and 8% by the end of the year, multiple offers again, and inventory shortage would be another problem once again. Probability of that is only 15%. So very likely for the summer, just to recap, we have a flat market, interest rates between 6.5 and 7. The second scenario is that we do experience a little bit of a correction, that the tariffs cause inflation and the Fed has to raise interest rates, which could slow down our real estate market further and cause a little bit of price decline. And then our final scenario, not as likely, but we'll see interest rates come down substantially and the stock market take off. So What's your strategy? If you are a buyer, first thing you want to do is get prepared financially. Get a pre-approval and get a rate lock. If you see rates dip down, lock in on that interest rate. The second thing you're going to want to do is look at properties and really determine where value is in the market. So you're going to want to work with an expert to help you determine where to place those offers and where to find value in the inventory that's on the market. And the last thing you want to do is, if interest rates are still high and you want to be in the market, talk to your agent or real estate expert about negotiating strategically. Consider getting a rate buy down, meaning asking the seller to purchase a credit from your lender to get a lower interest rate. This can enable you to get into that property at a lower rate and ride up on the equity increase as home prices appreciate. If you're a seller, few key things to consider. Number one, preparation is key right now. Homes that are selling quickly are ones that are well prepared for market. Number two, strategic pricing. In this market, depending on the area, you may need to price what we call transparently, which is right at the market, or you might need to price competitively, which is just below the market. But let the market inform your pricing strategy and work with an expert to help you make that decision. Third is professional marketing with great photography that will make a difference in how many buyers are seeing your home on market. And number four, if the market is slow, be flexible in your negotiations. Consider creative incentives like interest rate buy downs for your buyer who might be coming to make an offer on your home before you consider something like a price reduction. Either way, we can help guide you to making all of those decisions. So whether you're buying or selling, let's get together and build your game plan. Get back to the person who shared this video with you, and they will be able to do a hyperlocal analysis for you, whether you're a buyer or a seller, determine your timeline, and how to get you best prepared for the summer market. Until we talk again, this is Brett Jennings saying we'll be right here ready to help you create a better life through real estate. Have a great one.